The stock market is currently closed. The regular trading session concluded on Friday, May 22, 2026 at 4 p.m. Eastern Time, leaving BBAI Holdings under the ticker symbol BBAI at a closing price of $4.18 per share. This represents a minor intraday dip of 0.24% on the day, moving down exactly 1 cent from the opening price of $4.22. Despite the quiet surface action on Friday, the trading volume tells a wildly dramatic story, with over 65.4 million shares changing hands against a normal daily average of roughly 38 to 40 million shares. This massive spike in daily volume hints at deep institutional reshuffling behind the scenes, fueled by a breakout earlier in the week that pushed the asset past major resistance layers. While everyday retail accounts seeing the minimal price shift might conclude that nothing special occurred during the final session of the week, the underlying order flow points to an entirely different reality. BBAI just crossed an essential commercial threshold that changes its entire fundamental framework, moving far beyond the defense sector into global logistical shipping compliance. Specifically, the enterprise secured its first major commercial international deployment with the Panama Transshipment Group, the single largest logistics operator in Panama. This specific cross-border validation means the software is tracking high-consequence trade lanes, utilizing advanced biometric indicators to anchor transport vehicles and drivers directly to physical shipping containers and their underlying security seals. It represents a real-world pivot toward higher-margin, highly repeatable commercial subscription structures that can scale independently of the historically erratic and unpredictable defense contract award cycles. The baseline expectation across Wall Street and mainstream retail forums has long been that small-cap artificial intelligence enterprises are mere speculative shells, burning through capital without real-world utility or sustainable corporate demand. Investors who log on to basic trading applications often treat these entities as instruments for rapid intraday swings rather than businesses with structural longevity. The common belief is that unless a company is competing directly with mega-cap infrastructure providers, it has no viable path toward long-term operational cash flow. The reality, however, is that specialized decision intelligence platforms are capturing highly insulated, heavily regulated operational spaces where generic consumer software cannot function. Government entities, homeland security agencies, and major transshipment ports cannot simply integrate a standard consumer language model into their customs workflows. They require secure, authenticated, and deeply vetted software systems capable of analyzing fragmented data points under strict compliance standards. This massive disconnect between the casual retail perception of the stock as a speculative trading instrument and its true operational expansion creates a unique technical friction in the current market environment. Analyzing the recent price behavior reveals a fascinating tug-of-war between short-term technical traders and long-term accumulation desks. The asset experienced a powerful midweek surge, breaking out of a tight consolidation range near $3.85 and slamming into a multi-month high above $4.50 before finding a temporary resting zone around the $4.18 mark. This level of extreme intraday volatility is typical for micro and small-cap assets in this specific sector, but the elevated institutional volume suggests that larger wealth managers are increasingly using individual brokerage setups to build positions. Looking at major multi-asset platforms, the integration of algorithmic execution tools has allowed larger firms to absorb high volumes without immediately sending the stock into an uncontrollable upward spiral. This accumulation pattern matches the broader trends seen across modern digital asset spaces, where self-investing accounts and larger institutions alike utilize advanced trading platforms to capture early-stage infrastructure equity before the wider market recognizes the fundamental shift. When you examine the broader macroeconomic climate, the pressure on small-cap tech is undeniable, yet the defensive nature of this business model provides a unique buffer against traditional inflationary downturns. Federal agencies and massive global logistics networks do not cut their security or compliance budgets when economic indicators cool down. If anything, supply chain volatility and geopolitical friction increase the absolute necessity for specialized analytical software. Recent corporate filings indicate that management has reaffirmed its 2026 full-year revenue guidance, targeting a range between $135 million and $165 million. When you pair that target with an active contract backlog sitting comfortably at $281.9 million, the short-term visibility for operational stability looks significantly stronger than what the current negative trailing earnings per share would suggest. The financial community remains deeply divided, with conservative analysts pointing toward historical losses and accounting restatements regarding past convertible notes, while growth-oriented funds focus heavily on the expanding gross margins and the steady path toward positive adjusted EBITDA. Please leave a comment below stating exactly how many shares of BBAI you currently hold in your portfolio, or if you are simply tracking it on a watch list. To properly contextualize where this enterprise sits within the modern market, it helps to look at the competitive landscape of the software sector. The platform operates as a decision intelligence vendor, primarily serving national security, maritime trade, supply chain defense, and digital identity verification markets. Founded originally back in 1988 and subsequently restructured through key mergers before coming to the public markets via a business combination in late 2021, the firm avoids mass-market consumer software entirely. Instead, it focuses on high-consequence deployment environments where real-time accuracy and data engineering are critical. Its business model relies on converting custom government consulting agreements into standardized, high-margin software subscriptions. Historically, the main operational headwind has been the sheer lumpiness of federal defense funding, where a single delayed procurement cycle can distort quarterly revenue figures and panic casual market participants who rely on superficial screening tools. Looking out toward the remaining quarters of 2026 and into the late decade, the overarching corporate narrative will be decided by how effectively the firm balances its massive public sector footprint with this new commercial logistical expansion. There are two distinct forward paths that could materialize for the asset. In the optimistic scenario, the successful implementation of the shipping compliance software across the Panama Canal corridors acts as a definitive proof of concept, triggering rapid adoption by other global logistics hubs throughout Latin America and Europe. This would rapidly diversify the revenue mix away from heavy dependence on the United States Department of Defense, driving consistent top-line growth and commanding a significantly higher valuation multiple from institutional investment managers. Conversely, the primary risk scenario involves persistent cost execution friction and the dilutive overhang of outstanding convertible debt, which could restrict near-term net income growth even if gross revenues continue to expand. The expectation is that the business remains an unproven small cap, but the reality of a rising contract backlog and concrete international enterprise rollouts suggests that the fundamental floor is building much faster than the public market currently realizes. In summary, BBAI represents a stark study in market contrasts, where the short-term technical noise of a $4.18 stock price masks a significant institutional shift toward operational maturity. The general public continues to view the business through the lens of a volatile retail instrument, yet the massive surge in trading volume and the securing of dominant international logistics contracts reveal a company successfully deeply anchoring itself into global trade infrastructure. By analyzing the structural reality of the corporate backlog against the general market skepticism, it becomes clear that the business is quietly building a high-barrier defensive moat. Whether using traditional wealth management accounts or active modern trading platforms, market participants are forced to weigh the undeniable risks of historical net losses against the clear upside of an accelerating, real-world commercial footprint.